Every weekday morning, millions of independent day traders drop into the financial markets. It operates less like a traditional workplace and a lot more like a massive, highly competitive player versus player arena. But the survival rate is bleak. Roughly 90% of these daily participants will wipe out their capital, largely because they treat the market like a casino, guessing on which way a stock might move. Surviving this environment requires completely removing that guesswork. Professional traders rely entirely on a strict, mechanical loadout of technical strategies, executing pre-planned setups rather than trading on emotion. Staying in the game long-term doesn't come from getting lucky on a single massive trade. It comes from flawlessly executing a daily routine specifically designed to protect your account balance from fatal damage. That routine starts long before the opening bell. Think of the early morning pre-market session as the lobby phase, where a trader analyzes the charts to map out high-probability zones. This diagram illustrates supply and demand zones. These are specific, untested areas on the chart where institutional whales have previously left behind unfilled orders, creating a glowing zone of trapped liquidity that acts as a magnet for future price action. But even a perfect technical setup can be destroyed by outside forces. A strict pre-market routine includes reviewing the economic calendar for scheduled data releases, like inflation reports or central bank meetings. A professional scalper actively avoids these scheduled storms. When major news hits, unpredictable volatility takes over, rendering standard technical strategies entirely useless. By identifying exactly where on the map to fight and knowing precisely what times of day to hide in cash, the battle is often won or lost in the pre-game lobby. The exact second the 9:30 a.m. opening bell rings, a massive, chaotic surge in trading volume floods the market. Beginner traders often get caught in this initial frenzy. They immediately panic buy or short the open, effectively flipping a coin. Within minutes, rapid and violent price swings eliminate their positions. The professional scalper's opening move is very different. They do absolutely nothing. They sit on their hands and observe the chaos for the first 15 minutes of the day. This initial patience forces the market to reveal its hand, drawing a clear line between the predators who wait for confirmation and the prey who gamble on the open. Once the dust settles, the trader initiates their primary offensive mechanic for the morning, the opening range breakout, or ORB strategy. This chart shows the ORB. The trader identifies the highest and lowest price points from the first 15 minutes, establishing the morning's range. They then wait for a candle to explicitly break and close outside those bracketed lines, signaling a definitive direction in momentum. But a simple breakout on a chart isn't enough to pull the trigger. They need a real-time targeting radar to confirm if the breakout is genuine or a trap. That tool is the depth of market, or DOM. This ledger illustrates the live order book. The DOM reveals the exact volume of buyers, green bids, and sellers, red asks, at specific price levels. Traders watch for a massive order book imbalance, where the sheer volume of incoming orders heavily favors the breakout direction. The DOM confirms the volume is there, the candle breaks the 15-minute range, and the trader enters the position. They immediately execute the most critical mechanic in the entire profession, placing the stop-loss order the absolute second the trade goes live. The placement logic is strictly mathematical. The stop-loss goes just outside the opposite side of the breakout range. If the price reverses and hits that line, the trade idea is invalidated, and the system automatically ejects them. Professional traders adhere to a 1% rule. They calculate their position size so that if this stop-loss is triggered, they lose a maximum of 1 to 2% of their total account capital. Through strict risk management, inevitable losses become minor chips to your armor, rather than devastating hits that wipe out an entire account. When a trade works, the price moves in your favor and the screen flashes green. But that profit isn't real until the position is successfully closed. This upward trending chart illustrates how professionals secure their capital using a method called scaling out. Instead of holding the entire position and hoping it hits one massive, risky target, they sell in fractions. Once the price hits that first node, moving in their favor by an amount equal to their initial risk, they take partial profit. Immediately, they move the stop-loss on the remaining position up to their original entry price. At this exact moment, the psychology of the trade flips. With the stop-loss resting at break-even, the trader now holds a completely free trade, completely removing the financial stress. Scaling out acts as the ultimate stress mitigation tool. It ensures that a sudden, violent market reversal can never turn a winning screen back into a realized loss. The final targets are hit, the remaining position is closed out, and the scalper shuts down their charting platform for the day. Compare this to swing traders who hold their positions overnight. They have to leave their capital exposed while they sleep, hoping that catastrophic global news doesn't gap the market down before the morning bell. The scalper operates with a distinct advantage. They end every single day with 100% of their capital safely back in cash, holding absolutely zero exposure to overnight market risk. Finding consistency in the market isn't about making wild, adrenaline-fueled gambles. It requires the disciplined, emotionless execution of mechanics that allow a professional trader to extract profit, protect their capital, and survive to drop in again tomorrow.